Welcome back, traders and investors. We have Victor Ricciardi here. He is a co-editor of a book with Ken Baker on investor behavior, the psychology of financial planning and investing, available on Amazon. Hi, should I call you Victor or should I call you Professor?
Victor's fine. I'm very humble.
Okay, Victor. Good morning to you. So before we get into the book, just give us your definition of behavioral finance.
Behavioral finance is just taking the many aspects of psychology and applying them to finance, but also taking an alternative view of the traditional or expanded finance school that's based on rationality. Behavioral finance is based on that people make decisions based on bounded rationality, that we're influenced by our emotions, our cognitive processes, things such as heuristics, where we use certain rules of thumbs. So it's not that we're very crazy necessarily, but we don't always optimize. We sometimes base decisions based on our satisfactory outcome.
Okay, I think you kind of touched on it here a little bit, but just give us a couple of the basic themes of behavioral finance.
A couple, and trying even things that apply to traders, but also investors. People tend to be loss averse, meaning we tend not to like to take losses. So, for example, a $1,000 gain on the upside is an equivalent to a $2,000 loss on the downside. So, for example, a loss feels twice as painful as an equivalent gain, and that's noted by, say, something like the disposition effect, in which people tend to sell winners on the upside too early, and we tend to hold on to dogs or losing stocks too long. Another major aspect is people tend to be overconfident, in which they trade too much, and that eats away into their trading losses. Those are two major findings of behavioral finance.
Okay, Dennis is happy here in the chat room because he talks about loss aversion all the time, and that's how when stocks get away from people that hey, it's gonna come back, and I think that what when you go into this loss aversion, it kind of plays into the hands of our the technicians, like us, Dennis and I, and a lot of people on their show, because you do see where the herd from the charts gets caught up in stocks, and a lot of times you can identify those levels because they're when it comes back to that, like how many people are waiting for that bought GM recently, waiting for it to get back to $40. Oh, I'm not going to sell it now at a loss. I'm going to wait to get back to 40. Also, another aspect that Dennis talks a lot about, and we've written several articles. I don't know if this is part of your thesis or not, but the herd mentality.
Oh, well, yeah, definitely the herd or the group psychology, but just one reference to what is combined with loss aversion discussed in the book is something known as an anchoring effect, in which we have a reference point, and that's a central piece of what's known as loss aversion, but what's also related to what's known as prospect theory, and where we focus on that past trade. So if that last trade was positive, we tend to go the upside. But also, if that last trade was negative, we don't want to lose. We don't want to realize the loss. But also, people or traders especially tend to double down on the loss when they probably should sell the stock. Herd behavior is another issue in which people view, especially in times of a bubble or a bubble in asset category, in which people then follow the herd. And it's fine if you're early, if you got in early and you get out early, but the problem is if you're the person or the trader that follows the herd, and once the bubble pops, you're left with a losing position, because instead of buying low and selling high, the herd behavior many times leads to you buying high and selling low.
Okay, so a couple of your books actually just focus on traders' psychology, and we got a lot of traders here that listen to our show. Could you just talk about one or two chapters from the book that focus specifically on trader psychology?
Well, one chapter looks at trading and investor psychology. So it breaks breaks the trading strategies into short-term and long-term issues. So examples of short-term trading issues would be things like momentum. So there's definitely momentum in stock prices, and people can make money that way. Another piece of it that's very a short-term strategy would be looking at the hedge fund reports, in which you see what positions hedge funds are taking. Long-term strategies would be looking at things such as contrarian views and how you definitely make money going against the crowd. So rather than always following the herd, you sometimes take that contrarian view. Another major aspect of trading strategy in the book is also looking at earning surprises. So you're making the assumption that the stock prices do not always react quickly, so you're going against the efficient market hypothesis with that type of trading strategy. So that's more on the macro side. The other chapter, a couple chapters, look at the individual trader and how they make mistakes based on those behavioral issues, such as personality, overconfidence, so something like the hot hand fallacy, in which you assume that, for example, in baseball or basketball, the next hit is, you look at the probability that's going to increase, and so you think the statistical odds are going to increase. So then you take that same fallacy towards stock investing, in which if you made money from the last trade, you think you're more likely to make more money, or the same, or your next trade is more likely to be on the upside, making money from it.
Okay, the whole psychology. So, obviously, in order to write this book along with Kent, I mean, you had to get a lot of data, right? You had to get a lot of information. How did you go about that? Did you interview traders, or did you have just read other books on it, or really, because you're really talking about some information here. Did you observe trading rooms, or how did you come up with this information?
What's nice about it is Kent and I recruited 45 experts to write 30 chapters. And so they've all, so for example, 3 or 4 of the chapters deal with people who are trading coaches. We have a couple of experts who actually have studied through trading floors the actual people. So what's nice is many times it's hard for one person to write a book and have all this expertise. So rather than us try to be experts in everything, we went to the experts some are academics, but also some are actually people who are traders. Other people are people who provide coaching to traders and investing. So they take out many of the equations and they provide the research of what they've experienced, but also in terms of best practices, but also they provide a nice summary of much of the research going on. And then Kent and I probably spent about 1,000 hours editing all these people's work over the last 2 years.
Wow! And who are some of the trading coaches that are in the book?
Denise Scholl, she's been on CNBC a number of times. So she's really the primary expert, and then she has 2 colleagues who provide trading coach advice. They have their own businesses. I'm trying to think. Julia Peters.
Uh-huh.
She wrote a chapter. She's more an academic, but she's also starting her own firm currently based on trading psychology. So there's a number of astute people. There's just so many contributors that I think would be helpful, who again are academics and non-academics.
And what about actual traders that are in the book?
I would get I guess not actual traders, but I guess portfolio managers who actually manage money from a behavioral perspective. I think one person's name is John Lungo.
Mm-hmm.
For example. So that gives you just a sampling. I would say probably about 2/3 of the individuals are academics.
Okay.
Probably about 1/3 are investment professionals. And so I found it more difficult to find. We found it more difficult to find people who were not academics sometimes to write chapters in the book.
Okay, and so you've compiled all this information on trader psychology and behavior, and you've experienced the markets here. Is it helped you with your own personal investing?
Yes, it has. It's taught me that I shouldn't be a trader, so I'm probably the opposite. I've learned to be a long-term investor. So I take the position that I agree with modern portfolio theory and their tools. I just disagree with the underlying assumptions. So I tend to be a long-term trader, a long-term investor, but then I have money that I have learned just to use my IRA account, and if I'm going to buy an individual stock, I take about 10% of my own portfolio, and I just use that money, and then I take a long-term perspective with the other 90%. And also, the key thing I learned is to balance between my overconfidence and my status quo bias. So the thing I found, as far as being a long-term investor, is to rebalance. And I think even we have a study in the book that shows about 80% of people don't even rebalance their portfolios in terms of retirement funds, for example.
Right, and just as far as using the different asset classes, that's an important point. But okay, well, just also just from your studies here of the behavioral finance, obviously, how long have you been working? How long did it take you to produce this book?
Well, I was introduced to behavioral finance as part of my graduate work 15 years ago. In terms of knowledge, it's probably taken 10 years worth of knowledge to be able to handle doing this type of book. So, but we started working on this project about 2.5 years ago. So it definitely was a major undertaking, and I'm so happy that it's finally
Finally.
it's available to buy it now on Amazon. So it's certainly worth the purchase. I think the amount of hours that went into it. I think people provide. I think people will get a lot from this book.
Okay, and just to close out the interview here, I mean, with this market, especially in the time that you've been writing your book and stuff, the market has just been behaving perfect, right, for investors. I guess for a majority of issues, we've had a great run up in the market. Do you get any cues from trading, from studying the psychology of traders and hedge fund managers and stuff? I mean, are we just in a euphoric state here? Is the market just going to keep going higher forever? Or is there something that you're seeing in the behavior of the market that makes you a little bit skeptical?
Well, I mean, people are acting like these valuations are very historically above average, and I don't view it that way because I use a reference point to the internet mania in which the Nasdaq had reached 5,000, and if you take the time value of money, I still think the market is not necessarily reasonably overpriced, but I don't think it's the bubble. That if you look at comparable bubbles that were part of the financial crisis 5 years ago, and if you look at the bubble late 90s, I still don't view us in too much of a bubble necessarily right now. So I still think we have some time for some upside.
Okay, all right. We've had Victor Ricciardi here, who's co-edited a book with Kent Baker. Kent Baker, Investor Behavior: The Psychology of Financial Planning and Investing, available on Amazon. Studying trader psychology from several different perspectives. I'll definitely take a look at that book, Victor. Thank you very much for coming on, and it's great to have you on as a guest.
Oh, great! And people can follow me on Twitter at my Victor Ricciardi, my full name, or they can just search Twitter by Behavioral Finance, and my name will come up.
Okay, thank you, Victor.
Great, thanks for having me.